Hey everybody, welcome back to Dividend Stockpile. I'm really excited about today's episode because we're diving into the lineup of income ETFs from Invesco, the Income Advantage series, which includes QQA, RSPA, and EFAA. Invesco needs no introduction, as they are the company behind the massive ETFs such as QQQ, RSP, and for us dividend investors, SPHD, among many others. Joining me today is John Burrello, Senior Portfolio Manager at Invesco, to break down what makes these funds unique, how they generate income, and how investors can use them to stay invested in the market while collecting consistent cash flow. So John, welcome to the channel. How are you?
Doing great, Jeremy. Thanks for having me.
Absolutely. Really appreciate you coming on. I know these particular ETFs have been out for a little over a year now, but when I was doing some research on them, I thought they were extremely interesting. And I think a lot of people would be really interested to know that Invesco has these, higher income or income focused ETFs. So can you give us just a quick background on yourself, what you do at Invesco, and maybe how these products came to be?
Sure, absolutely. So I've been in the option markets for a little over 20 years. I spent the first half of my career at an equity long-short hedge fund in Chicago that was, mainly focused on managing risk with options, but also investing in the equity markets. And so we went through a lot of interesting cycles there through the global financial crisis. A lot of different periods where managing risk was, of course, important. But also, collecting yield and harvesting premium from the option markets as well. And so when I joined Invesco in 2022, we began to develop the option-based capabilities here to deploy some of the strategies that you can, do with options, mainly income-focused or hedging. And today we deploy both of those for our clients, both for institutional investors and also retail. And we do this around the world. You mentioned that it's been about a year since we launched the Income Advantage ETFs in the U.S. We did that in July of 24. But actually, our experience with what is now called Income Advantage started back in 2018. And I thought I'd maybe give a little background on the genesis, like why did we create this strategy? This is a dividend investing channel, so I think a lot of your audience will appreciate this. In 2018, we found ourselves in multi-asset portfolios, investing in dividend-focused stocks, trying to extract income from the equity markets. But the challenge with that was oftentimes you find yourself concentrated in certain segments of the market. You might be in utilities or REITs or mortgage REITs, MLPs, stuff like that. And that's great, for some parts of your portfolio. But if you want to maintain diversification, and you don't want to be reliant on kind of a value bet that often comes with having kind of a dividend focused portfolio, it can be a challenge to only have those sectors to choose from. So we started to look at, are there ways for us to maintain diversification to big, broad kind of market exposures and reduce risk while increasing income? So have a much higher quality portfolio that's more diversified. And that's where the option income overlay came into play. We started to deploy that in 2018, again, within our multi-asset funds. In 2021, we launched our mutual funds that were based on this same process. And that's where the name Income Advantage first kind of came about. And then last year, we were really excited to extend Invesco's kind of top two brands, being the NASDAQ 100 and also the S&P 500 equal weight. So that's when QQA launched on the NASDAQ 100, RSPA on S&P 500 equal weight. And then we also launched on MSCI EFAA. So EFAA is the ticker there for the international version. And now we have these kind of large building block, again, diversified exposures where we can add income and reduce risk for investors.
To the ETF landscape, there's so many ETFs that are coming out there, especially these higher income ETFs. I mean, just here on my channel, I've interviewed everything from a 2% yield to 100% yield funds. There's so many choices out there. So how can an individual investor really filter through all these different options out there to decide what's best for them? And what kind of advice might you give when it comes to picking the one that fits our individual styles?
Yeah, Jeremy, I appreciate you asking me about that because, as I look at the landscape, it's like there new products getting launched almost every day. It's daunting. If you're trying to make sense of how are these all different from each other, first thing I'd say is across this space, they are very different. So if you look at these fund launches that are option income, I would definitely caution the audience to say, do not paint them with a broad brush that, oh, it's just another covered call fund or something like that, because the design details really matter under the hood. So I can maybe simplify this by giving you a handful of things to look out for, because these are going to be design choices that everyone has to make. And then when you look at each fund, you'll be able to see how did they address these kind of different design criteria. So maybe the first one I'd say is, don't forget about the stock portfolio. So what are the equities they're being invested in each of these funds? Typically, these are equity-based funds. And does that stock portfolio actually match the options that are being used? So I bring this up, think about a traditional covered call. If, let's say, you're trading a covered call on Apple, you would buy Apple stock, and of course you would sell a call option on Apple. You probably wouldn't buy Procter & Gamble stock and sell calls on Apple against that Procter & Gamble stock. That'd be a mismatch. And so I think it's really important to know that, because actually in this space, something like 20% of the funds available have a pretty significant mismatch between the stocks and the options. And that can create some noise and surprises, because think about, if the market's going up on the option that you sold, take the S&P 500, for instance. If you sold a call on the S&P 500, but your equity portfolio is not the S&P 500, that can create issues as the market, rises. Maybe you're not really covered. So that's one thing, is I would look at the equity portfolio. Does it actually match the options? In our case, of course, we are replicating pure index exposure on the stocks for QQA, RSPA, EFAA, and then we're selling index level options against those exposures. Now, second thing I'd point to is the option portfolio itself diversified? So kind of put simply there, we think options should be diversified just like stocks or bonds or any other asset class that you would invest in. But more often than not in this space, what you'll find is maybe only one or two options in the portfolio at a time. And the issue with that is then you've got a lot of path dependency. Options expire. So you don't want to be beholden to just one kind of section of market returns through time and have that dependency. We ladder our positions every day. So even though we're trading 1 month options, today we're recording on the 9th of October, we'll be targeting the November 9th today, and then tomorrow the 10th. And so we're laddering out each day. That really smooths that path dependency and keeps us diversified in terms of strike prices, et cetera. That can be beneficial, particularly in volatile times. So I think that's a really important one. Trading only on the third Friday, in our view, is not enough. That really opens you up to a lot of risk. So diversifying is key. The third thing I'd point to is consistency of the income. So, a lot of people listening are probably going to be wanting to collect monthly income from some of these funds, but it's not a great experience if sometimes that yield is 15, 16% when markets are volatile. But then markets calm down again, and you're like, hey, well, I'm only getting 5, 6% now. Having that yield tethered to something like the VIX can be, again, a bad experience. It actually is maybe not optimal from like a return perspective either. So we've developed our strategies to adapt the strike prices through time to keep that yield consistent. So I think that's really important. But you also want a consistent beta profile, meaning your up and down participation. We don't really want that to be moving all over the place either. And so some thought needs to be put into how the portfolio is constructed to keep the beta consistent through time. You can think of the income advantage ETFs as having a beta profile of about 0.75. So they're going to essentially behave about 3/4 up or down relative to the underlying index. And of course, we aim to improve on that, capturing more than 75 up, less than 75 down. But I think that's a good framework to think about kind of the risk return. some of these strategies that are out there, they don't have a design that prioritizes stability of that participation. So
Mhm.
again, you can be really surprised if you see the beta like moving a lot through time. And then lastly, I would look out for funds that have yields that look too good to be true.
Mhm.
I think this is a really big one, Jeremy, and you've talked about this a bit on previous shows. Like NAV erosion is a really big issue to watch out for, and I think a really simple framework for people listening would be if you are investing in a fund that has, say, a yield of 50%. Let's use that as an example. Well, now that fund's total return must exceed 50% per year for it to not return your own principal back to you. And they're going to charge you hefty fees in the process to give your own money back. We all know that the greatest investors of all time cannot compound even at 20% per year.
Mhm.
So in our view, like that's just unrealistic to think of a yield that high. That's why our yields, we try to have a balance of growth and income. QQA, we're aiming for around 10% annualized income. RSPA about 9%, EFAA about 8%. Yes, those are high, very attractive. It's nice that they're not interest rate sensitive, but they're not so high that we can't also grow your capital. We don't want to be just returning your principal back to you. We want to distribute that income and have it grow as well. And I think even when you see these yields that are 14, 15%, a lot of times those are going to be unsustainable too, because even bull markets, these broad markets are not compounding at rates like that. And if you've got even less risk than the broad market, it's really difficult to kind of maintain that level of income without returning investor principal.
Yeah, so much good information there and good advice, or good recommendations of what to look for. There's so many nuances to these ETFs that you really do need to do your research. You really can't just go based on what someone put in a Reddit forum or on X or whatever, saying, "Oh, this is the one I use." You really need to dig into it to make sure it fits your needs. And to be honest, for probably 99% of the investors, it should be a total return is what you're looking for. You shouldn't want these 100% yields, but your total return is 15 a year, or something like that.
Yeah.
So really consider about what the total return and the total package really looks like on some of these ETFs you're investing in. On a very high level, can you explain kind of what your ETFs focus on or what the strategy is, especially compared to the ones you had just mentioned, the 100% yields or 50% yields? How do you guys do it differently?
Yeah, I mean, so I kind of just mentioned our yields are, we're aiming for the yields being kind of 10, 9, and 8 for QQA, RSPA, EFAA. Again, those are responsible yields
Mhm.
in our view. Like we think we can actually grow your capital at the same time we're making those distributions. That has been the experience for all three of the ETFs since we've been live. Um, Over the long run, our aim is to keep it that way. So relative to those other funds that have these really high yields, frankly, I think they're being a bit misleading when they're advertising those yields out there because again, like the vast majority of that income is going to end up just being your own principal returned back to you. And I think what's really frustrating for us to observe is that it's oftentimes the funds that have the highest yields that also charge the highest fees. So they know that they're just charging you fees to pass your money back and forth. And so, again, in our case, responsible yields, but we're also priced at only 29 basis points for
Mhm.
QQA and RSPA. EFAA is at 39. But these are very much like on the lower end in terms of fees. So that's really important too, trying to provide the overall experience that's attractive for investors. When we take a step back and think about our investment philosophy, and how I think it differs from a lot of others in the space, it boils down to outcome orientation. Three things we're after:
Okay.
income, and we want that to be stable, of course, but also participation. So how much upside and growth can we provide from you investing in these broad markets, but then defensiveness too. So those three things, the challenge with any of these strategies is to keep those balanced and consistent requires a lot of thought and data and design and an active team that's, we've been doing this again for more than 20 years. We manage $15 billion in the derivative space. About 5 of it is in pure option-based exposures like this. It takes a team to keep a balance across income, participation, and defense that clients can rely on. So that's, kind of the guiding principle is basically that triangle across those 3 items, and how do we keep balance there?
Okay. So 2 questions on the strategy that I have is, what percentage of the portfolio are you doing options-based or derivatives-based strategies on compared to letting the rest of it increase with the market? And then what kind of trading are you doing? Is it covered calls? Is it ELNs? Like, what are you doing to actually generate the income?
Yeah. So on the first one, we're covering half of the portfolio with options. And that doesn't change. So we're not changing the size of the overlay, which goes back to beta stability. We want a consistent experience from upside participation. The reason we don't use the whole portfolio goes back to NAV erosion. We want to have a growth engine there. We don't want to completely stunt the growth of this portfolio with only focusing on income. Yes, our yields might be twice what they are today, but the total return would suffer if we were to do that. So back to your point, Jeremy, total returns are really key. Having a balance is important. Now, in terms of how we implement the option exposures, when we're trading this portfolio, it looks and feels to us like we're trading options. So direct options, index options. We do wrap them into equity-linked notes. So ELNs, or equity-linked notes, are basically a wrapper for the option exposures. And there are a few benefits that we see from that. It goes back to transparency. So from a tax perspective, we're able to generate pure bona fide income out of these portfolios. And that's key because we won't have return of capital. And we also are not in a tax straddle position, which is really important. I think there's a lot of confusion around this topic in particular in the marketplace. Tax straddles, we've been advised by our tax advisors on this. I'm not a tax expert. I would encourage everyone to have their own tax advice. But what we've been advised on is that it is beneficial in terms of transparency to deliver pure non-straddle income without return of capital. And so that's a motivation behind using the ELNs. It also gives us transparency in terms of the maximum exposure that we have to the option markets without having any margin calls. So what I mean by that is the prospectus in all 3 of the ETFs limits us to a maximum of 10% exposure to ELNs. In practice, we only have about 5% of exposure to the ELN structure, which are fully funded exposures. There's no leverage in them. And they're diversified across, call it 8 to 15 banks at a time. Because they're fully funded and they're such a small portion of our portfolio and they're laddered and expiring monthly, we think we've really minimized that counterparty risk that comes with ELNs. Yep. But that transparency means that when you look at our holdings, if you see a 5% weight to ELNs, you know that even if the index went to 0, or if all the banks in the world failed in a 30-day period, the most you could lose is 5% on the overlay. And that can be difficult to calculate if you're dealing with index options or having to deal with margin calls and that type of thing associated with that approach. So that's why we've chosen to implement that way.
I heard you talking a couple of times that you use index approach. Does that give you the Section 1256 contract tax rates, or is that not the case for this fund?
So that's another area that I think there's some gray areas and confusion in the marketplace on. So 1256 contracts is something that I mentioned. We manage about 15 billion in derivative exposures. Much of that is in 1256 contracts where the 60/40 tax treatment is in play. When you're distributing option income through time, I would encourage everyone to look at financial statements and actually see, are you really experiencing 60/40 tax treatment? Again, in our view, is when those distributions come to play, and if you're doing return of capital, and if you're in a tax straddle, 60/40 can go out the window. So there often is not 60-40 treatment. I think that's why most of the players in the space do not prioritize that, because it's really not achievable to have 60-40 distribution treatment on your option income. So that was something we looked at very hard. It's something, again, that we don't think is actually practical to have. But we do trade index options.
Mhm.
They are cash settled. We can't be called away. Those are wrapped into the ELNs so that we've got the tax transparency. We're not in a straddle. We also maintain qualified dividend status, which you can lose if you trade the index options. Your dividends will be taxed at short-term rates. In our case, we maintain the favorable treatment on dividends.
So where does these particular ETFs fit into a client's portfolio, would you say?
We're seeing clients use it in a variety of ways. I'd say probably the most popular and maybe most timely use case is that most investors fall in one of two buckets. They've either been already invested in the equity markets and the markets have had an amazing run. They could be in a point of their life or just getting nervous about markets where they want to de-risk, take some chips off the table, but maintain exposure to the broad equity markets and add income that, again, is not rate sensitive. The Fed is in a rate cutting cycle now, so income producing assets are a bit under pressure, but there's also a lot of uncertainty about what's going to happen with kind of interest rates and more traditional sources of yield. Mm-hmm. So if you've already been invested in markets and you want to downshift your risk a bit, Income Advantage has been a place where investors are turning to do that. It's like an intermediate step. You're still getting exposure there. You're taking about 20 to 30% of your risk out, though. The second kind of broad bucket there would be people who are on the sidelines. And, I saw a stat yesterday, we're up to $7.5 trillion in money market fund assets. There's a lot of money that's not participating in the equity markets. Mm-hmm. But some of those investors are concerned that, hey, valuations are, near all-time highs. We've had an amazing move already. Is now really the time to jump in with both feet? Well, with a kind of less risk version of those broad markets, you can get in with Income Advantage, with QQA, RSPA, EFAA, and get a foothold so you participate. And if we end up going into a cycle where it's more muted returns, you don't have like the crazy bull market double-digit return environment for the next 5-10 years, you'll still be getting paid a monthly yield to be there and be invested in the market. So I think that's those are kind of the most broadly used use cases. And then another one is just supplement to dividend stocks. As we talked about at the very upfront, that's how we originally designed this product for ourselves, was as a way to enhance the experience around more diversified exposure to income from equity markets. We can often do that without having the value bet or the concentration risk that you have with kind of being crowded in dividend names.
Any kind of income investing, generally speaking, you're getting paid whether the market is going up or down. And so that's a huge benefit. That's one of the reasons why I am a dividend investor, because no matter what the share price is, no matter what the market's doing, I can pretty much guarantee that I'm going to be receiving my income either on a monthly or quarterly basis. So that's why I became an income investor. So it's really good points. And it's nice to see that the broader audience, that's investing in your funds, is taking a similar approach to that. So that's really great to know. All right, so talked a lot about this QQA, RSPA, and EFAA. Where can people find more information about these ETFs?
Yeah, if you just search Invesco Income Advantage, there are some really good web pages out there that have been created dedicated to the suite. So I think that's probably the easiest way to go.
Yeah, and I'll make sure to put all the links up on the page as well. Well, John, really appreciate all the information about your Income Advantage Series ETFs. Again, it's QQA, RSPA, and EFAA from Invesco. Thank you very much for your time, and we'll talk soon.
Thanks for having me.
Thanks. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.